financing. We talked about this in the risk-based side, but we want to really dig in here on what this financing looks like. We have obviously seen a lot of things in the news about various banks going under because of poor balance sheet management, which I think is something that's very important to note, is that they were not managing their balance sheets correctly, which is one of the reasons that we love conservatively underwriting and stress testing. But another point that I think we should make is we've actually seen rate stabilization. If you go back and look at the 5-year Treasury, on June 30th of last year, the 5-year Treasury is exactly where it was today. So there's a lot more stabilization in rates than people might imagine. Now, that probably doesn't even matter too much on this deal because of the way that we have underwritten the deal. But as we look at this and go through it, just a couple of high points here. We have flexibility with our loan terms, modeling 75% loan to cost. We have a plan to refinance into agency debt upon stabilization of the property. Agency debt, what is that? Fannie, Freddie, HUD. All the low fixed long-term loans are federally backed. Once stabilized, and this is a very important number to remember, our effective leverage will be 45% loan to value. Robert, can you touch on that number and just what that means to a project like this from a risk standpoint?
Absolutely. I think the nice part about that is what I would call a stress test. So worst case, let's just say we are not able to take any money out of the deal. We just need to refinance the construction loan. Well, if you look at the value of the property once it's stabilized versus that construction loan, it's about 50% of the value. And that's where you want to be. Great. So at the end of the day, we're looking at a $120 million project from a value standpoint that we're going to build for $60 million all in, rough numbers. And that's the kind of deal that you want to be involved in when you're doing development, because it gives you some flexibility. The other thing I want to point out, there's a bullet point down below to this point too, but we've got a structure or a stress test in place right now where let's just say that interest rates don't move between now and 2-3 years. That's actually the way we underwrote this deal. So the existing 10-year Fannie Freddie note that you can get right now today with the interest rates where they're at is what we underwrote. Now, I think if I took a poll here tonight and I asked everybody, hey, in 2 or 3 years, do you think interest rates are going to be higher or lower? I'm betting most people are going to say, I think they're going to be lower. Inflation's going to be gone. The economy is going to come back, whatever. So again, we're being conservative about that and saying, what if we have to refinance this just as it is today? Nothing's changed. Let's make sure that deal still pencils. So just kind of a side note there as well.
Yeah, that's a great point. I would be in the camp of saying I think rates will be either where they're at or a little bit lower as well. However, you know, knowing that we have that flexibility if they do continue raising rates, it helps me sleep at night. But again, we want to come back to the conservativeness of the underwriting here. We're assuming in this that we will refinance or dispose, which we don't think we ever want to sell this property. This is premium property, a durable asset. But theoretically, if we're putting together pro forma, right, we're assuming a 20 basis point, that's 0.2% increase each year in the cap rate. That means we are projecting it to be worth less based on the market than it is today in our underwriting. Again, that just comes back to conservative nature on it. We're also modeling a conservative 18-month lease-up period. So 18 months for construction, 18 months for lease-up, 36 total months. In this market, bringing an A-class brand new product at the lowest or very near the lowest price point, we think 18 months is also conservative. So you're going to hear me say that word probably too many times tonight, but this is what we're doing to try to mitigate the risk for you, the investor, also for us as the general partners as well. We haven't noted this yet, but Robert has secured this land $5 to $7 million under market price. That's a 10% savings across the whole project just in the land acquisition price. So there's built-in equity just in the bare land as it sits today. Also, we should know, I'm sure this gets noted on every webcast that you see from REM, but in-house construction and project management for tighter oversight and better controls. It's all just trying to get you the best value investment for your dollars.